Hello everyone. So we are going to start today unit number 4. In unit number 4, we have following topics to cover. The first topic 4.1, it is about different types of expenses and liabilities. And this is the very important topic because from here we will discuss about purchase commitment. We will talk about also warranty, accounting for warranty, and we will also talk about accounting for contingencies, right? Then we have our topic number 2, which is about leases. Topic number 3 about what income tax. Topic number 4 is about accounting for bonds and non-current notes payable. And these are the topics which we are going to cover. So initially we are starting with different types of expenses and liabilities. So here we go. This is very common topic for your CMA exam also. The reason general questions can be asked on this topic. So starting with first point, which is purchase commitment. So let's understand what is the purchase commitment and what we are going to do. So guys, for example, purchase commitment. Commitment is the word like a agreement. For example, I'm assuming today is, let's assume 31st October, year 1, just we are assuming. At this date, you are going to sign a contract that you will buy certain products in future, right? For example, you are going to buy 1,000 units of XYZ product and at a price of, let's assume, $5 each. This is the contract which you have signed with your supplier. Okay, but you will buy the goods. But you will buy the goods, for example, on 31st March, year 2. I mean, say right after, for example, 5 months. So you will buy the product. The price is what price which you have agreed with the supplier, that is $5. Now you can see here, this is your date of contract and this is your date of actual purchases, right? Date of purchase. This will be your date of purchase. In between these two dates, you have year end. What do you have? Year end. And at the end of the year, price could be different, right? Price where in the market, but you have agreed price is what? $5. Maybe the price could be $4 also. In the open market, you might purchase this product on 31st December, which is year end. Okay, you can buy at $4. Now, if you will buy through the contract, obviously, because you have non-cancelable contract, right? You have signed non-cancelable contract at the rate of 5, but in the market, what is the price? $4. It means you are going to buy the product at higher prices, right? And it is non-cancelable contract. So how much loss you are incurring? $1 for each unit. So total loss will be how much? 1,000 units are there. So $1 for each unit. 1,000 units are there. So total loss you will incur how much? $1,000. This loss you have to accrue. You have to book at the end of the year. You are getting my point, right? So the gain you are not allowed to book due to prudence concept. There could be a gain. Maybe in the market price could be what? $6. But you are buying at which price? $5. You might have a gain. So as per prudence concept, gain should not be booked until unless it is realized, right? But loss you have to accrue. So this is what we are going to talk about. Purchase commitment, accrual of loss, and what entry you will pass. So whenever you will have a loss at the end of the reporting date, the entry will be what? You will debit unrealized holding loss, right? This will be written under income statement, and you will credit what? Purchase commitment or your liability. It is your liability because this loss will be settled in future. So is it is going to be your liability also. Right? This is what only we have to learn about purchase commitment. And I will show you example also. But first, to solve theoretical question, we need to understand theory also, right? As I have given you the overview. So now let's have a look what they are trying to tell you. So a commitment, because we are talking about purchase commitment. A commitment is what, guys? A commitment to acquire goods. When you are going to acquire the goods in future is not recorded at the time of agreement. The date when you are signing the contract, you don't need to pass any entry. Okay. The goods are recognized as inventory when they are received. Obviously, at the time of purchase, once you will buy it, that time you can record the inventory. Right? At the time of contract, you will not pass any entry. Next word, but, however, a loss is recognized on the firm's non-cancelable purchase commitment if the current market price, which was in my example $4, if current market price of goods is less than commitment price. Loss you have to agree with. Here we have point number C, material losses expected on purchase commitment are measured in the same way as inventory losses. Because if you remember inventory topic, we were also, if we were having a loss that time, we were also booking the loss. Okay. So then they're saying and recognized and separately disclosed. Here, guys, this point is also important. Entry, as I told you, just I'm going through theory now, then I will show you example. The reason for current loss recognition is the same as that for the inventory. Because in inventory, we have booked the losses, if you remember. Right? Losses for what? When your market was less than cost. So we were booking the loss. Okay, a decrease, not an increase, because increase you are not allowed to book due to prudence concept. Increase means a gain. Gain you are not allowed to book. Only decrease. In its future benefit should be recognized when it occurs, even if the contract is unperformed on both sides. As I told you, you have to focus year-end losses. Understood? And we have studied the entry also. What is the entry? Now let me show you all these things with the help of examples. So here we also point number 3, which we need to understand. The nature, like if you are booking a loss, obviously in your financial statements, the nature and the term of contract, means the obligation, must be described where in the notes. Notes means in the disclosure to the financial statements. Understood? So now let's have a look with the help of example. For example, during the year, this is the example. Company signed a non-cancelable contract. Non-cancelable contract to purchase how many pounds? 2,000 pounds of what? Material. Okay, at $64 per pound. This is the purchase price which you have agreed. How many pounds you are going to buy? 2,000. And what is the price which you have agreed? 64. During the forthcoming year, this purchases will be done in upcoming year. On December 31st, we are assuming this is our year end. Okay, December 31st. The market price of the material is how much? $52 per pound. And selling price of the finished product is expected to decline accordingly. It's just a statement. Here, this is additional information we also need to keep in mind. Assume that date of actual purchase is what? February 1 of the next year. Right? Today I'm assuming before the year end. Before the end of the first year we signed the contract. There is a year end. And then on February 1 of year 2, we will buy the product. And at which price you will buy? Obviously, at $64. Then on June 1 next year, after the purchases, because on February 1 of next year, you are going to buy actually. And then you on June 1 of year 2, L company sold the inventory for what? $70 per pound. This is the sale, whatever you have purchased in February 1. So now how you will record the entry? Just you have to focus with this example, what I'm doing. So here we go, guys. First of all, what are the requirement? Requirement is what? Record the double entries. In your exam, you will not be asked to record double entries at each point, but they will ask you only what to do with the losses. So losses, I told you have to debit, loss, credit, liability as a purchase commitment, right? And loss will be immediately reflected where? In the income statement, and gain you are not allowed to book until unless it is realized. Understood? This point you need to know for your exam questions. This is just for practice, just to make it clear how purchase commitment will work. So guys, first of all, you already know, like when you at the end of year, please, at the end of the first year, which is let June 31st, December, year 1, right? So how many pounds you are going to buy actually in the contract? 2,000 pounds. And what is the agreed price? 64 pounds. So it means actually whenever you will buy, you have to pay $128,000 whenever you will buy, because you agreed. But what is the market value at the end of the year of that material, right? So market value is how many pounds? $52 per pound. And how many pounds you are going to buy? 2,000 pounds, right? 128,000 you will pay at the time of purchase. But at the end of the year, the market value of that material is how much? 104,000. Understood? Right? How much you are going to pay extra? 24,000, the difference, right? Understood? Or in other words, we can do this way also. So agreed price is how much? 64. Market value is how much? 52. What is the loss? $12 is the loss per pound. And how many pounds are there? 2,000 pounds. Total loss is going to be 24,000. This loss you have to book. What entry you will pass? Guys, this entry you will pass at the end of the year. Not, please remember, we will not pass any entry at the date of contract. We will pass entry only at the end of year to agree with the loss as adjusting entry. Understood? Otherwise, you don't need to pass any entries, right? So here we go. So we will debit the loss. With this loss, where you will write in the income statement by 24,000, and we will credit what? Liability, purchase commitment, with the name of purchase commitment, or contract liability, you can use the word 24,000. So this liability will be settled. Okay. Now guys, if you look at here, this entry will pass at the end of the year. That's it. Now what? Now if you remember the question, guys, in question what he told you, what is your actual date of purchase? Actual date of purchase is what? February 1 of the next year. And obviously you will buy at which price? At 64 pound. Right or wrong? So what entry you will pass now? Please just focus with me, guys. So now this is the entry at the time of actual purchases, which is February 1 in my example. Right? So first of all, what you will do? You know one side of the entry, that is cash. Cash will be credited because you are going to buy how many pounds? 2,000 pounds. And what price you have locked? At the time of contract, 64. So it means you are going to pay cash of 28,000. Okay. Then on debit side, what you will do? The liability which you have booked here at the time of loss, this liability should be removed because this contract is going to settle. Right or wrong? So we will debit this liability, okay, with 24,000, same amount. Right or wrong? And remaining difference, I'm using word what? The difference. The difference you can take what? To the inventory account, because you are buying inventory, right? So what we will do, we will take the difference to the inventory. That's it. February 1 issue is solved. What happened now? You have removed the liability which was booked in balance sheet. This liability, it is removed here. Right or wrong? You have recorded the inventory which you have purchased, and you have recorded the cash which you have paid. Now February 1 matter is solved. Now what you have to think? You have to look at the date of sale now, because you sold also. On which date? June 1. You sold, I'm assuming you sold 2,000 pounds, and you sold it for how many $? $70 per pound. And guys, you know, whenever we make sales, we also record the cost of goods sold, right? Nowadays, we are working on accounting softwares. When you book the sales, obviously system is automatically recording the cost of goods sold. But here, just entry, you should know what is entry for cost of goods sold also. So first we have to record the sales with $70 per pound. So what entry will pass on June 1? So this is the entry on June 1. June 1 is the date of sale. At the time of sale, what you will do, guys? First of all, you have to record the sales. Okay, so what entry you will pass? You will debit receivables if it is credit transaction, or you will debit cash if it is cash transaction. How many pounds you have sold? 2,000 times $70, right? So you will get here what? 140,000, and you will credit what? Sales means a revenue account, okay, with 140,000. Understood? And at the same time, you also need to record the cost of goods sold. Think logically, because you sold the inventory, whole inventory. So inventory should be credited, right? Because you have to remove, it is sold. So you will credit the inventory with 104,000. From where you got this value? This value, because you have recorded inventory at 104,000. Right or wrong? So this inventory should be credited with 104,000. And what will be debited then? Cost of goods sold. Understood? So guys, now we are going to talk about warranty, right? Let me just explain what is the warranty first, then how many types of warranty we have, and then we need to learn the accounting for each type of warranty, and then we will do some exam standard questions. So first of all, how warranty is defined? A warranty is a written guarantee of the integrity of the product or service. For example, when you buy mobile phones, it's a very common example, right? So the seller will give you warranty mainly for 1 year, right or wrong? This warranty is for what? This warranty is for the product specification. Like if product specification, the product will have any issue, you can bring this product to the seller and claim the warranty. So he might fix the issue, he might also replace the mobile also, right or wrong? So this is called warranty. Warranty is what? It's a written guarantee of the integrity of a product or service, right? Then guys, the seller also agrees to repair. As I told you, if product will have an issue, he will repair your product or he will replace your product. Okay, or maybe he will refund all or part of the price, right? Or provide additional service. So this is what is called warranty. And now guys, there are two types of warranties there. One is called assurance type warranty. I'm explaining warranty types. There are two types. One is called what? Assurance type warranty. Assurance type. Second is called service type warranty. See what is the difference first. So you know this, just I have to link the information. For example, when you buy the mobile phone, for example, you bought the mobile phone for $1,000. By default, in this purchase price, for how many years warranty will be there? By default, mostly it is for what? 1 year, right? Right or wrong? Are you paying something here extra for warranty? No. So that is why this is called inseparable warranty. Which warranty? Inseparable word I'm using. Inseparable. What is inseparable warranty? Inseparable warranty mean to say this warranty is included in the purchase price. You don't need to pay separate amount for that. Okay? If within the warranty period your product will have any issue, you can claim the warranty. Seller either he will repair or refund or replace the product. Understood? This is called which warranty? Assurance type. So how you will define assurance type? Like here warranty is included in the purchase price. You don't need to pay any separate amount. But what is the service type warranty? Service type warranty, you can also say like extended warranty. Which warranty? Extended warranty. Extended warranty is what? I'm giving you just example from your normal life. Let's assume you are going to buy a mobile. Price is $1,000. And in this $1,000, 1 year warranty is included. This 1 year warranty is assurance type. But seller is giving you option. They are saying, sir, if you will pay $100 extra, we can give you extra 2 years warranty also. So total warranty will be how many years now? 3 years. So this for extended warranty, which is 2 years, you are paying extra amount. You are paying what? Extra amount. So this is what is called service type warranty. So how you will define service type warranty? Service type warranty is also called separable warranty. Which warranty? Separable, because you are paying separate than purchase price, right? So that is why the accounting for assurance type warranty is different and accounting for service type warranty is different, right? In your exam question, he will never mingle these two things together, right? He will give you separate questions. Either question will be tested on assurance type or will be tested on service type. So let's first start with the assurance type warranty. So here we are talking about assurance type warranty. Okay, I told you what is assurance type warranty. Assurance type warranty is also called what? Inseparable warranty. So here we have some data you can just go through. I have already explained. Okay. Service type warranty here is also explained, right? I also give you examples, so you can just go through this one also. Clear? Now, guys, we are going to talk about accounting point of view. So starting with accounting for which warranty? Assurance type warranty. Because when you will read the question, you have to identify first types of warranty, which type it is. Is it assurance or service? If it is assurance, you have to follow assurance type warranty accounting rules. If it is service type, you have to follow service type warranty accounting rules, right? And don't mingle. So first, starting with assurance type warranty. So here we go. Assurance type warranty creates a loss contingencies. What is loss contingencies? I will explain, don't you worry. And we follow which accounting? Accrual accounting should be used if. What is accrual accounting? I will explain. Let me just read 3 statements first. Right? We will accrue the liability and expense. I'm using both words. We will accrue the liability and expense if what? If warranty expense is probable. Probable means there are high chances that customer will come and claim for the warranty. High chances, high likely. Second is what? The amount can be reasonably estimated. How you can estimate the amount of warranty? That how many customers will come to claim the warranty? Due to you can estimate the values by using your past experience. Because you are selling goods every year, right? You have a past experience. And from that experience, you can get the percentage on average, how many percentage of customers, right? They are or they will come to claim the warranty, right? And third is what? Amount is material. Material means it's significant enough. You cannot ignore. It is not a negligible amount. It is a handsome amount, a hefty amount. Okay, understood? So how you will do? Maybe you are thinking what he's saying. I told you simply you are following accrual concept here. Accrual means you will book expense and liability if 3 conditions are there. Condition number 1 is what? If it is probable that there are high chances customer will come. Second is what? Amounts can be reasonably estimated based on your past experience. And third is what? Amount is material. It is not negligible. If 3 concepts are there, so you have to accrue the expense and Liability. This is also called expense and liability approach. And how it is going to work, let me help you with the help of examples. First, I will explain the double entries. What entries you will pass, then we will apply these entries through the question. And then I will tell you how MCQs will be tested. So here we go. First of all, entries. Being a student, you also need to be aware with the double entries. Entries related to which warranty? Assurance type warranty. Right? First of all, now assume you are sitting at the time of sale. Right? First entry, what you will do, guys? The first entry you will record with the sale price. And please remember, you are sitting at the time of sale. What entry you will pass? For example, you sold a product with the sale price of $100,000. First, you will book the normal sale price. Clear? So normal sale price, a normal entry for sale, what will be the entry? Debit, receivables, or cash, depending upon transaction is credit or cash based. And you will credit what? The sales means say revenue with 100,000. Right? Now I'm using word at the same time first. At the same time. Same time means say what? At the time of sale. Let me say first this way. At the time of sale. So you have to what? You have to estimate. Right? You have to estimate the warranty, liability, and expense based on your past experience. For example, your past experience says that 5% of the sales value, mostly you are paying in terms of warranty. This percentage will be given, 1%, 2%, or 3%, it will be given. So I'm assuming for the sake of simplicity, it is 5% of which value of sales value. So you have to pay as a warranty. So what entry you will pass? You will take 5% of the sale value. It is going to be 5,000. What entry you will pass? You will debit the warranty expense, right, with 5,000, and you will credit the warranty liability with 5,000. Now you might think how it is possible. With each sale, I have to book warranty entry also, right? It will increase your work, burden of work. So most of the companies, what they are doing, they are having policies. Sometimes they are booking this entry weekly. Sometimes they are booking this entry monthly, or maybe at least daily, if you can do, right? So you can just collect the rate of sales of the whole week or of the whole month and record this entry. Because with every sale, if you are working with Sharaf DG, they are selling thousands of mobile phone daily, thousands of electronic equipment daily, right? So with each sale, it is not possible, right? So they can pass this entry weekly, monthly, or daily basis if they wish to do. Understood? So it means at here, but for book, what I told you, when you book the sales for your book, for your exam, when you record the revenue, this is a cruel concept also. You are also recording relevant expense, right? You are also recording the relevant expense, warranty expense. Understood? Clear? Now, guys, we have to remember that this entry is passed. These two entries are there now. Now you have to wait. I'm explaining only entries first. Then I will take you to the example, and I will explain through example also. Now, guys, at the time of actual warranty cost payment, let's assume I'm assuming this warranty is for 1 year. And I'm also assuming you have only one warranty account, for example, or only one sale, just for the sake of simplicity. Then we will work with continuation process. Okay. For example, the customer, there are 3 to 4 possibilities are there. Maybe customer will come, right, for the repair of the product or to claim the warranty. And that time, maybe you paid. The cash payment is exactly equal to the warranty liability. Let's assume first scenario is what? Your cash payments for the warranty claim exactly equal to the warranty liability. This is the first scenario. So what entry you will pass at the time once the customer will come? You will debit the warranty liability by 5,000 because you are booked with the 5,000 initially. And you will credit what? cash. If you're paying cash, maybe sometimes you're hiring some people from outside to repair your product. You might pay cash to them, or you might replace the product. In that scenario, you will credit the inventory. Right or wrong? This entry you will pass. Scenario number one is clear. What is scenario number one? If your warranty payments are exactly equal to warranty liability, this entry you will pass. Right? Scenario number two, what? If your warranty payments are greater than what warranty liability, what to do? For example, you made payment of how much? 6,000, but warranty liability was how much? 5,000. What you have to do now? So first of all, you have to credit cash or inventory. Okay, with this value, what you have paid? How much? 6,000. Second thing, you have to debit this liability which you have booked initially. You will debit with the name of what? Warranty liability by 5,000. And you can see the difference of 1,000 on debit side. Where you will record? You will debit further to the warranty expense account. Understood? It means warranty expense can be recorded again if your warranty payments are greater than warranty liability. Right? Because it is change in estimate, Initially you were estimating, oh, it is 5,000. Later on it became 6,000. It's change in estimate. You don't need to adjust previous records. Right? Retrospective effect is not required. Prospective effect is required. Scenario number three is what? I have said it's clear, right? Scenario number three is what to do if warranty payments are lesser than warranty liability. For example, warranty payments are 4,000. Warranty liability was 5,000. So what you will do now? At the time of payment of the warranty, what entry you will pass, guys? First, you will debit the warranty liability account. By how much? Not 5, 4,000. And you will credit what? The cash or inventory by 4,000. You can see in warranty liability, initially it was recorded how much? 5. But it is debited by how much? 4,000. There is a balance in liability. How much is the balance? 1,000. And now you will sit and wait until the expiration of the warranty period. The day when warranty period will expire. So what entry you can pass? Because still there is a balance in the liability account. You can debit again warranty liability by how much? 1,000. And you can credit what? Maybe to the other income. Right or wrong? Understood? You should not take it to the main revenue stream. You should take it to the other income. So 3 scenarios I have explained, guys. Scenario number 1. What if your warranty payments are equal to warranty liability? Scenario number 2. What if your warranty payments are greater than warranty liability? So extra will be recorded as a warranty expense, right? Third scenario is what? What if your warranty payments are lesser than warranty liability? Then extra amount which you have in warranty liability will be taken to the other income only at the time of expiration of warranty period. Understood? Now how questions will be tested? This is also important, right? So you need to aware with one statement. This statement is called warranty liability account. Which account? Warranty. Actually, it's a ledger account, but I am writing in statement form only, right? Because you need to know this equation. Because from this equation, most of the question will be tested. First of all, this equation is for what? Warranty liability. For warranty, actually it's a warranty liability ledger. This ledger I'm going to write in statement form. So how this equation you have to memorize, guys, please. You have to write opening warranty liability balance. Opening warranty liability is what? Because normally we sell product every year, right or wrong? It's a continuation process, right? So you will always have opening warranty liability. Okay, you will add here warranty expense for the period. What? Warranty expense for the. Do you remember when you record warranty expense? What entry you pass that time? You debited the warranty expense, and you have credited what? Warranty liability. So liability is credit, that's why you have added here, right? And then third thing, you need to subtract warranty payments. Warranty payments for the period, whatever you have made payments. You know, for warranty payments, what entry you passed? Debit warranty liability, credit cash or inventory. So warranty liability was debit. You will subtract here. Okay, this is how you will get ending balance of warranty liability, which will be reflected where? In the balance sheet. Now see how many total items are there in equation 4. First item is what? Opening. Second is what? Warranty expense. Third is warranty payment, and the fourth is the outcome of the first three. If any three things are given out of these four, can you calculate the missing one? Right or wrong? For example, if I want to calculate this value, what is this value? Warranty expense for the period. How I can calculate? I need to reverse the equation now. Once I will reverse, I will start with what? With the ending warranty liability. I will write on my calculator. When you go reverse, minus will become plus, plus will become minus. So I will plus this warranty payments, and I will deduct opening warranty liability. Automatically on my calculator, I will get warranty expense for the period. Clear? This was the whole idea about assurance type warranty. So let's do one example first. Actually, it is one question. From that question, I will explain both years accounting. Okay. So, but in your exam question, he will ask you one specific amount to calculate, not so many things, there's so many entries. Understood? So here we go. This is the question which I have just explained. Okay. Now guys, here we have an example here, and see here you will learn some things, how to apply the estimates also. Because here you can also make some mistakes. So we are starting with the example. I need your concentration. I can solve this question within 1 minute also, right? But we need to go through year by year. I will explain accounting for both years here, what you will do. And then I will tell you summary. Okay, so here we go. In year 1, company began selling a product under 2 years warranty. This warranty is for how many years? 2 years. Okay. The estimated warranty cost are 3% of sales in the year of sale and 5% in the following year. Actually, what it means? It means total you will pay 8%. Total you will pay 8%. But what is your estimate? 3% you will pay maybe in the first year, and 5% you will pay in the next year. 3% in the year of sale and 5% in the following year. So, but total you will pay how much? 8%. So what mistake you will make? You will think like that, oh, in the first year I have to pay 3%. So you will multiply with the 3%. It is incorrect. You have to multiply sales value with total estimated payments. Total estimated payments are 8%, regardless whenever you will pay. Understood? This is the common mistake which you will make. You might think, oh, I have to pay 3% only in the first year, so I will book expense and liability of 3%. No, you have to book expense and liabilities for the total payments, regardless when you will make it. Understood? So total payments are how much? Total percentage is how much? 8%. 3% in the first year and 5% in the second year. Then what? We have some other information. Here what is telling you? Sales and actual warranty payments. Sales and actual warranty payments for year 1 and year 2 are as follow. So he told you data for sales and for warranty payments, not warranty expense. Warranty payments, because expense and liability will be booked based on your estimate, which is 8%. So, but these are sales and payments. So sale is how much in year 1 sale? 300. Payments are 5,000. In year 2 sales are 500,000 and payments are $37,000. Right? So I'm just asking you, my point only, I'm asking you to do the counting for both year from entries till the balance, till the financial statements. And then I will solve in shortcut way for any given period. Understood? So look at here, in year one, first detail I'm sharing with you. In year one, what you have to do? These are the entries for year one. In year one, we have a sales of 300, warranty payments of 5,000, and we have an estimated expense liability 8%. So what I will do, guys, at the time of sale, I will record for sale value. And for year one, my sale is $300,000. I will debit the receivables are cash with 3,000, and we will credit the sales with 3,000. And now we will take this sales value and we will multiply with the 8%. Right? So I will get how much? 24,000. So with this 24,000, I have to record warranty expense and warranty liability. We will debit the warranty expense and we will credit the warranty liability by 24,000. And then we know there is one payment also of 5,000 in the first year actual payments. For actual payments, what entry I will pass? I will debit the warranty liability by 5,000 and I will credit the cash or inventory by 5,000. Understood? Can you complete the equation now? First equation. If I'm asking you what is the ending warranty liability? Ending warranty liability for the first year. So you have to apply the equation now. Opening warranty liability. There is zero balance. This is year one calculation I'm doing. Because there is nothing provided about the opening warranty liability. Then you will add here what? Warranty expense for the period. For the period. Okay. I hope it is clear. Warranty expense for the period. How much is for the period warranty expense? We have booked here 24,000. Our liability 24,000. Then you have to deduct what? Warranty payments for the period, which is how much? 5,000, because you have made payments 5,000, right? Liability is debit here. So this will be your ending balance. How much ending balance? Ending warranty liability of 19,000. Clear? This ending warranty liability of the first year will be the opening warranty liability for the second year. Understood? Right? This is going to be the opening liability for year 2. Understood? Okay, can I ask some question from you? Okay, here just because sharing just detail of the topic, then we will. So this is the ending liability. We have already calculated 19,000, right? Right. Now, what are the entries in year 2 you will pass? Again, you will follow the same process. In year 2, what is the sale? In year 2, what is the sale from the question check? 500,000. So you will pass. And what are the payments? 37,000. And what is expense again? 8%. Because year 2 sale also you have to apply with, you have to multiply with 8%. So remember this data and pass the entries. For year 2, guys, first you are recording the sales. This is for year 2. You will debit receivables or cash by 500,000. You will credit sales by 500,000. And same, you will multiply this sales value with the 8%, because he told you 3% will be paid in year of sale, 5% will be paid following the year of sale. Right? So totally 8%. So once you will multiply, so you will get how much? 40,000. So what entry you will pass? You will debit warranty expense and credit warranty liability by 40,000. Right? And in year 2, there is warranty payment also of how much? 37,000 is given in the question. So you will debit warranty liability by 37,000 and credit what? Cash or warranty by 37,000. Can you calculate warranty liability for year 2? Warranty liability for year 2. So for year 2, we have to do now. So you will write first opening warranty liability, which is coming from year 1. So it was how much? 19,000. You will add here warranty expense for the period. Which is how much for the period warranty expense or liability? 40,000. You have to deduct warranty payments for the period. Warranty payments are how much? 37,000, right? 37,000. You will deduct. So the remaining balance will be what? Ending warranty liability. How much? 22,000. Clear? In your exam question, mostly we will ask you the question from these equations. Understood? I hope that is clear. Right? So this is what about assurance type warranty. Now we are going to talk about service type warranty. Okay? Now guys, we are going to talk about accounting for service type warranty. I have already told you service type warranty is also called what? Separable warranty. Separable warranty, right? And what we are going to do, this is also called extended warranty. So see what process you will follow for the accounting of service type warranty. I'm just giving you example here for the first entry. First entry, what entry you will pass? For example, you sold a mobile for $1,000 and you sold extended warranty. Which warranty? Extended warranty for $100. Right? And this extended warranty is for how many years? I am assuming, for example, 2 years. So what entry you will pass initially? Initially, you will debit cash. Because how much cash you have received? 1,100. Okay? And then you will credit what? Sales. Sales with what? Sales for only mobile, because this is the only performance obligation which is satisfied because you have delivered the mobile. So you can book the sales of how much? $1,000. And what to do with this $100? This $100 is also your revenue, but not normal revenue. It is your deferred income. Which income? Deferred income, deferred revenue. You cannot book immediately right now, because this revenue should be booked over 2 years. Because your performance obligation is not satisfied, you have to provide warranty. You have to provide warranty services for 2 years. So that is why so far we will credit to the deferred revenue a deferred income. Okay, this deferred income is like a liability. Understood? This is the first entry. First I'm explaining entry. Now guys, what you will do? Now you have to wait. If customer will come to claim the warranty, second entry I'm telling you. If customer will come or visit to claim the warranty and maybe you paid 4,000. So I'm putting here actual warranty payments are how much? 400, let's assume. Or maybe $40 only. Okay. So what entry you will pass? You will debit. This is what at the time of payment. You will debit warranty expense. You will debit what? Warranty expense by 40. And you will credit what? Cash or inventory by 40. So here what you are doing? Here when you are booking expense at the time of sale or at the time of payment? At the time of payment. This is the difference. There in assurance type, we were booking expense at the time of sale. Here you are booking the expense at the time of payment with the actual amount. Understood? Now what else you have to do? Else, because this deferred income should be taken to the revenue, but over 2 years. So what I will do, simply I will divide this amount with how many years? 2 years. We are following straight line method to book the revenue. So yearly amount will be how much? $50. What second entry I will pass? I will debit the deferred income by how much? $50, and we will credit what? The revenue, but revenue from warranty. Okay, how much? $50. This is the year one entries. In second year, I am assuming if customer, for example, if customer came to claim the warranty and we paid $30, so what entry you will pass? You will repeat this entry. Debit warranty expense by $30 and credit what? Cash or inventory by $30. If you will not come to claim the warranty, this entry you don't need to pass then. Understood? If you will not visit in second year, you don't need to record this entry then, right? But this entry you need to pass again, second entry, because this deferred income should be taken to the revenue over the warranty period. Again, we will repeat the entry what? Debit deferred income and credit what? Revenue by remaining $50. That's it. This is what is called your service type warranty. Understood? Clear? Now let's do small examples to understand. Because when you do the question for assurance type warranty or service type warranty, so you have to keep it separate. Okay? Right? You have to keep the both information in your mind. So guys, here one problem is here with one entry. First entry, because I will show you the question also. First entry was what? Debit cash, credit revenue, credit deferred income or contract liability, because it's your liability. Cash will be debit with the transaction price. Right? For example, in my example, you received $1,000 for mobile, $100 for warranty. So total was how much? 1,100. Credit will be a revenue with the transaction price allocated to the product or to the performance obligation which is satisfied, like mobile phone you sold, you delivered. And credit will be a contract liability, which was your warranty, right? I told you this. Now here, let me show you one example. These entries I also told you. Whenever you are making what? Actual warranty payments. So what entry you are passing in every year? In each year, debit warranty expense, credit, cash. And for the deferred income, which you booked initially over the warranty period, what entry you will pass? Debit deferred income, credit what? Revenue, right? I told you these entries. So here we have a question. Let's do this question. I would request you first, guys, please read this question carefully. So guys, here we have a question where they're trying to tell you, they're saying on January 1, XYZ company sells a machine plus 2 years separable warranty. So two things we are selling, machine and 2 years separable warranty to a customer for how much? $200,000. We sold together as a package. And how much transaction price we have received? $200,000. But see what's the next information. The machine estimated stand-alone selling price. Stand-alone means, say if you will sell only machine, so you will get how much? 190,000. And stand-alone price for 2 years warranty is how much? 30,000. It means 190,000 plus 30,000. Total is how much? 220,000. But you sold both things for 200,000. So first we need to allocate this 200,000. Okay, between warranty and to machine. Then XYZ company provides repair evenly during the year, during the 2 years warranty period. Actual payments. Now here we have actual payments. actual payments during year 1 is 6,000 and during year 2 is 3,000. So what you will do, because initially you have to record this entry, first entry. What is the entry? Debit, cash, credit, revenue, credit, contract liability. But how you will get the amount? Cash will be debit always with the 200,000 with the transaction price, whatever you have received. Only now here problem is with the credit side. Right or wrong? Because you sold as package and transaction price, which is $200,000, you have to allocate to the machine now, and you have to allocate to the warranty, right? And how you will allocate? You will always use market values, standalone prices to allocate. And this is how you will work. Please go through. So we have to write here first performance obligations. We have two things. We have delivered the machine and we have to provide warranty over 2 years. And machine standalone price is how much? 190,000. And warranty standalone price is 30,000. Total is 220,000. Right? So what you will do? Just convert into percentage this data. So what I'm going to do, I will take 190,000 divided by 220,000, like market value of machine divided by total market value, and times 100. So you will get here 86.36%. Right? Same way you will do for warranty. You will take warranty market value divided by total market value. Right? You will get how much percentage? 13.64%. Now once these percentages you got, so it means transaction price was how much? 200,000. 86.36% of this transaction price, we will take it to the machine, and this is going to be how much? 172,720. And 13.64% of this transaction price should be taken to the warranty, and this is going to be how much? 27,280. Right? Understood? Sometimes he might give you directly these values, but sometimes you have to calculate this way also. Clear? So once you got these values, now you will credit the machine revenue here. Obviously, machine is delivered, so you can book the revenue with machine value and credit the contract liability or warranty liability by deferred income, sorry, by 27,280. Clear? First entry is gone. Now you have to focus on the question back. First entry is passed, and now record year-wise entry. In first year, how much is the actual payments? 6,000. What entry you will pass in the first year for this 6,000? You will debit warranty expense and you will credit cash by 6,000. Right? One thing is done. Second thing, what? This warranty, I would say deferred income, you have to take over 2 years to the revenue. So once you will divide by 2, so you will get yearly revenue how much? 13,640. So you will debit here what? Contract liability, credit revenue. These are the entries in the first year. So what entries you will pass in the second year, guys? Again, you have to record expense. This is year 2 I'm writing here. So you have to record debit, warranty, expense, credit, cash with the actual payments, and actual payments in year 2 is, I guess, 3,000 in the question here. Right? So you will record this entry with 3,000 and 3,000. Second entry, you also need to book this deferred income entry. Okay, what entry you will pass? You will pass the same entry, debit, contract liability, and credit what? Revenue, by which? By same amount, 13,640, 13,640. Clear? So over 2 years, what happened? You recorded warranty expense and you also recorded revenue also from the warranty, but over 2 years. Understood? Clear? Clear, right? Now I'm going to show you some questions for the warranty. Guys, which 30 you are talking about? Rain, you are asking one question. From where the 30? Which 30 you are talking about? Before in previous question? No.
Starting in this separable 100.
Okay, Reem, I will take your question later. I don't know where you are asking. Maybe I have seen later. Yeah, maybe 30% was estimated. I'm not sure what you are exactly asking now. You can just open your chat if you want to ask right now. Please open your chat. I mean, say open your mic.
You know that assuming that is in the same way, what is the different like you move that a different amount, which is you pay like 6,000 in the first year, but the actual amount is
Yeah, okay, that was the example actually.
what is the difference?
Yeah,
between them?
that was the example, Reem. I'm not sure you are there. Okay, now guys, here, let's do some questions, please.
This is a 17,000 for the full expense. But
So guys, here we go. We are going to do some questions and see how questions are going to work. Please, can you go through this question, guys? Read this question. Okay, thank you. So just read this question, please. So guys, here what we have to calculate? We have to calculate in its income statement for the year ended 31st December. The company should report warranty expense. So we need to look, is it assurance type warranty? If it is assurance type warranty, so we will take sales value multiplied by estimated percentage to record as expense. But if it is a service type warranty, so actual payments will be recorded as expense. Okay, so here we have to look, a company manufactures a stereo system that carry a 2 years assurance type warranty. So it means warranty expense, how you will calculate sales value multiply by percentage, whatever value you will get, with this value you will debit the warranty expense and credit the warranty liability. Right? So here, then they are telling you based on the past experience, warranty costs are estimated at 4% of the sales for the warranty period. Okay. During the year, stereo system sales totaled how much? 3 million is the value of sales. 3 million. And percentage is how much? 4%. How much it is? 120,000. It means obviously then we no need to read next anything, right? So warranty cost incurred how much? These are the actual payments. Warranty expense is recorded this way: sales time, percentage of sales. So it should be 120,000. Option B is correct. Understood? Read this question also, guys. Even answer is on your screen, but don't look for the answer. Huh? Just read the question. You have read this one? So they're saying, guys, again read the question requirement first. What is the requirement? based on, okay, the question is, what should the entity recognize these warranty cost? When should the entity recognize these warranty costs? When? So here we go. An entity sells appliances that includes a 3 years which warranty? Assurance type warranty. Service calls under the warranty are performed by independent mechanic under the contract with the entity. Based on experience, warranty costs are estimated at $30 for each machine sold. When should the entity recognize these warranty costs? When it should be recorded? At the time of warranty cost means a warranty expense. When it should be recorded? At the time of sale, as I told you, under assurance type warranty. Right or wrong? Read the next question, guys. So what is the question here? At June 30, what amount should the corporation report as estimated warranty liability? Warranty liability is asking at June 30. June 30, most probably it will be year end, right? Okay, so here we go. So it means year end liability you have to calculate. On April 1, corporation began offering a new product for sale under a standard 1 year assurance type warranty again of 5,000 units in inventory at April 1. Okay. $3,000 had been sold by June 30. You have sold how many units? 3,000 units. Based on experience with the similar products, the corporation estimated that average warranty cost per unit sold would be $8. Tell me how many units you have sold? 3,000 time what? 8. It will be how much? 24,000. This should be your warranty expense, debit warranty expense, credit warranty liability. Okay. Actual warranty cost incurred. This is the actual payments. From April 1 through June 30 was how much? 7,000. So what is the warranty liability at June 30? So you have to write the equation actually. Opening warranty liability 0 plus warranty expense for the period, which is 24,000, this value, minus warranty payments, how much? 7,000. So then this will be your ending warranty liability at June 30, how much? 17,000. So these kind of questions will be tested, guys. Okay, I hope so you got the idea about the questions. Clear? So next question, I'm just showing you on your next question you will do from your software. Okay, other questions. I was thinking maybe there are more questions. So here we go. Now we are going to talk about another topic from same topic number 4.1. Here we go. We are talking about now what? Contingencies. Okay, contingencies. Contingencies are what? First, guys, you have to understand this definition. Let me just give you example first before this definition. For example, I'm the seller. Maybe I'm selling some toys or some products. So I sold some goods to the customer, and maybe the product were chemically contaminated. Some chemicals were there. As customer has used these products, he got injured. So what he's going to do? He's going to file a case against me in the court for the compensation. Right? Now, guys, there could be a year end, and maybe our case still is in the court at the end of the year. So maybe I have to think, do I need to pay anything for compensation or not? If answer is yes, then I need to ask the question, do I need to book provision or liability for that or not, right? So this is what is called gain contingency, loss contingencies. Like the party who will pay damages, for that party it is a loss contingency, and the party who will receive compensation, for them it is a gain contingencies, right? So we have to understand what is the contingencies here. So here we go now with the definition. Guys, there is a definition. A contingency is an existing condition. The wording is a bit tough. Situation or set of circumstances involving uncertainty, because we are uncertain. We don't know we have to pay or not, right? As to possible gain. As I told you, the party who will receive the compensation, for that party it is a gain contingencies. Or a loss. I told you the party who will pay for the compensation, for that party it is a loss contingencies to an enterprise that will ultimately be resolved, because this case will be resolved when one or more future events occurs or fail to occur. We don't know what will happen in the future, and this case will be resolved in the future. Maybe we need to pay for compensation, or maybe we don't need to pay, right? From payer point of view, it is loss contingency, and from receiver point of view, it is gain contingencies. Now, first we need to know the accounting entries or accounting treatments from payer point of view. Okay, I would say for loss contingencies. Okay, so there are three types of contingencies could be there. It could be a probable. Probable means say it is high likely that we have to pay. High likely means high chances are there. Not in terms of percentage, I cannot express. Standard use the word high likely, means more chances are there, you have to pay. Second is what? Reasonably possible. Reasonably possible means to say chances of occurrence is more than remote but less than probable. What is remote first? Remote means say chances of occurrence is slight, negligible. Right? So that is called remote. If any contingencies which is not probable, which is not remote also, so we will use the word what? Reasonably possible. Understood? Now, guys, accounting. Accounting depends on either the chances are probable, reasonably possible, or what? Remote. It's not a hard and big topic, it's a very small topic. Let's go through. Guys, probable. First, I'm going to tell you here for probable what you will do. If chances are probable. Please listen me. If chances are probable, so we are talking about probable loss contingencies, like there are high chances that we have to pay. If chances are probable, plus there is another condition, the amount of the loss can be reasonably estimated. These two conditions. First thing is what? If chances are probable, and second condition is what? The amount of loss can be reasonably estimated. If both conditions are met, so then we have to record debit expense, credit what? liability or provision. Okay, credit what? Liability. This is called accrual. Accrual of expense and liability. This entry, when it is required, guys? When this entry is required, if chances are probable and amount can be reasonably estimated, then this entry is required. Right? Understood? Now, guys, we also need to know what should be the amount for this entry. So there are different scenarios. Please don't forget. I'm talking about if chances are probable plus amounts can be reasonably estimated, right? Reasonably estimated. So what we have to do? We have to debit expense and credit liability. What the point is that what should be the amount? This is the question. What should be the amount? So for amounts, he can play with you here. Which amount you have to book expense and liability. Okay, please remember, I'm giving you example here. For example, what you will do? Being a company, you will call your lawyer or any legal advisor. You will ask him, sir, I have this kind of case. What is your opinion or experience? What will be the outcome of this case? He told you, you have to pay compensation, for example, and compensation could be the amount between $1,000 to $4,000. So here it means what you are provided? You are provided with the range. This is called what? Range. Now you got confused here. So should I book with 1,000 this entry or with 4,000 or with 2,000 or with 3,000? Because range is there. So you will ask another question. You will say, sir, okay, there is a range of 1,000 to 4,000. Do you think any amount from this estimate is better estimate? Any amount from this range is what? Better estimate. He told you, yes, the most probably 3,000 you have to pay as a compensation. So it means whenever range is provided, what? Range is provided. And in question it is told you from this range, XYZ value is better estimate. Like for example, here I'm assuming 3,000. So what I will do, I have to book expense with 3,000 and I have to book liability with 3,000. Plus I have to give disclosure. What? Disclosure. Like in this footnotes, I have to explain I have litigation, pending litigation, right? For that, this liability is booked. But in disclosure, you also need to write, okay, risk for further risk for potential loss also. And how you will write the risk for potential loss? So you have to take the maximum amount. Which amount? Maximum amount from the range minus the liability which you have booked. So additional disclosure you have to give for this amount also. What is the maximum amount in the range? 4,000. And what is the liability you have booked? 3,000. It means you have to disclose 1,000 extra also. Because 3,000 you have already booked. 1,000 you also need to disclose that this is the risk to the potential loss or further loss. Understood? This is the first scenario. Scenario number 2, with the same scenario. If amount is probable and reasonably certain, we need to book expense and liability. Again, the point is with the amount. What is the amount? Scenario number 1, I told you, if legal advisor is giving you range and any amount is the better estimate, then you have to book this liability and expense with the better estimate. But now your legal advisor is telling you, sir, there is no amount which is better estimate in this range. No amount which is better estimate. It means every amount is having equal chance. What? If no amount is better estimate, in other words, it means every amount in this range is having a equal chance. In that scenario, what liability you will book? So you have to book the liability with the minimum amount from the range. What is minimum amount? 1,000, right? If no one is the better estimate, then accrue with the minimum amount and in disclosure follow the same rule. What is the rule? Maximum minus liability. Liability is how much? 1,000, and risk to the potential loss is 3,000. You have to disclose. Understood? Question number 1. If there is any better estimate is there, then book the expense and liability with that amount. What you will disclose? Max minus liability. Right? If no amount is better estimate, or in other words, if every amount is equally likely, having equal chance, then accrue the which amount? Minimum from the range, and give the disclosure according to this rule, max minus liability. Understood? So this is what you will do with what? With probable loss contingencies. Right? If now second scenario number 2. Scenario number 2 is what? If chances are what? Reasonably possible. Chances are reasonably possible. What are reasonably possible? Like it is more than remote, but lesser than probable. Right? Right? So what to do? If chances are reasonably possible, no accrual is required. What? No accrual means no need to pass entry, debit, expense, credit, liability. We don't need to record this. Only what is required? Only disclosure is required. This is what is written. If at least one condition is not met, maybe it is not probable or amount is not reasonably estimated, but probability of loss is what? Least reasonably possible. Like it is, as I told you, reasonably possible. The nature of the contingencies must be disclosed in the notes to the financial statement. Only disclosure is required, no accrual. Third scenario is what? If chances are remote, you don't need to do anything. Do nothing. No disclosure, no accruals. Understood? If chances are remote. Clear? Now I'm talking about for what? Gain. Loss contingency, I told you 3 scenarios: probable, reasonably possible, and remote. Right? For gain contingencies, gain. Guys, we will not do anything about the gain unless it is received, because as per prudence concept, gain cannot be booked until unless it is realized. Understood? So have a look here. Gain contingency, this statement you have to memorize, are recognized only when realized. When realized means when it is received. Only at that time you have to book. What entry? Debit, cash, credit, other income, whatever you can use. Again, contingencies must be adequately disclosed in the notes. In case if it is received, you have to also give disclosure. Yeah, for us some differences are there, but just you have to remember here, until unless it is not realized, don't book. If it is realized, you can book and you can also disclose. For example, award of damages in lawsuit is not realized if it is being appealed. For example, you just filed a case that you want this much compensation. It doesn't mean it is realized. It is only appealed. Understood? So you will book only if it is realized. So now guys, here we have examples to do. For example, if we have a question, please focus with me. I'm reading this question for you. Guys, they're telling you during year 1, Crab company was sued by Apple company. Apple is the claimant here, right? And Crab is the defendant. For patent infringement, at the end of year 1, Crab legal counsel believes that unfavorable outcome is probable. Chances are probable that you have to pay, right? And estimated amount of loss is in the range of what? 100,000 and 15,000. As I told you, if chances are probable and amounts can be reasonably estimated, so you need to book the liability and expense, right? Debit, expense, credit, liability, but a range is given. For range, I told you 2 rules. If amount is better estimate, use that one. So let's have a look. All amounts in the range are what? Equally likely. It means there is no amount which is better estimates. What rule I told you? We have to accrue minimum. So you have to debit, expense, credit, cash by 100,000. And what is the disclosure? Max is what? 500,000 minus liability, which is what? 100,000. So 400,000 will be what? Disclosed, right? As a exposure to additional amount of loss. Disclosure, right or wrong? Understood? Scenario number 2. Again, I'm assuming here, same data we have. Like again, we have a case, okay, and this is the range is available, but now scenario is changed. Now assume that Krabs legal counsel believes that loss of 200,000 is the better estimate from this range. It is probable and range is given, but 200,000 is a better estimate. So what you will do? You will debit expense, credit the liability by what? With the 200,000, because this is better estimate. And what will be the disclosure now? The difference of maximum, which is 500,000, and liability, which is 200,000. So 300,000 will be disclosed as an exposure to an additional amount of loss. Understood? Clear? Scenario number 3. We are assuming same data above, but these are the changes. Now assume that Krabs legal counsel believe that an unfavorable verdict is only reasonably possible. So what do you have to do? You have to, if reasonably possible, only disclosure is required. What if it is remote? Nothing is required. Understood? So we have one question to practice, guys. I would suggest you first, please, can you go through this question? Read it properly, please. So guys, let's have a look. The question they're saying, what are the effects of this lawsuit's probable outcomes? Outcomes are probable, right? If amount is also reasonably estimated. So you have to debit expense, credit, liability, plus you have to give disclosure. So let's have a look at the question. They're saying Invern INC has a self-insurance plan. Each year, retained earning is appropriated for contingencies, like you are taking some part of the profit you are putting for contingencies. Is an amount equal to insurance premium saved less recognized losses from the lawsuits and other claims. It's just information. As a result of year 4 accident, Invern is a defendant, or it is loss contingency, in lawsuit in which it will probably have to pay damages of 119,000, and it is probable and amount is also reasonably estimated. So you have to book expense and liability plus disclosure is required. Number 1, an increase in expense. Yes, expense will increase because you have to record. No effect on liability. No, it's incorrect. Liability you also need to book. Second is what? Increase in both expense and liability. Correct. Expense also increasing, liability is also increasing. This is correct option actually. No effect on expense and increase in liability. Incorrect. Right? No effect on either expense and liability. Incorrect. Understood? So option B is correct. So we have one more question. Read it. Yes, what is the question? Here they're saying W company has the probable loss. Word probable. That can only be reasonably estimated. Right? Reasonably estimated, guys, within the range of outcome. What the company probable loss that can only be reasonably estimated within a range of outcome. No single amount with the range is better estimate. So what to do if no amount is better estimate? Minimum amount you have to agree. So which is correct answer? D. Because minimum of the range you have to agree. I hope so guys it is clear. So see you next time. Next time we will talk about lease or we will talk about bonds. I will see which topic I want to teach first. So thank you so much guys. Thank you so much. If you have questions, you can ask me.